I see. It's on. Yes, it's as far as I get it is now on. I don't know. Do you see anything
Yeah,
showing you
it's
that?
receiving the sign recording. So now it's okay. Thanks.
Okay. Moment. Like it started. And what is the practice? Okay, if you touch that situation, what is the practice you usually have at the moment? Are you making recordings of all the lectures?
Yeah, actually we do.
Okay, I'm just curious if it's in university, how do you record that?
So far we have only a few lectures and seminars in university, so mostly they are offline and they all recorded. So it's like the best practice for now.
Okay, okay. Now let's proceed. That's the management fee example, right? Let's say we have the so-called ABC venture fund, and the size of the fund is 100 US million dollars. The term of the fund is 10 years after the initial closing, and has 1 year extensions at discretion of general partner. And let's say the investment period in some states, commitment period is 5 years after the initial closing. We took the most widespread situation. So half of the fund life is investment period, and the management fee is 2% per annum, so every year of committed capital for the first 10 years of the fund. So actually, the whole fund life before any extension. The distribution waterfall is the following. First 100% of contributed capital should go to investors, to limited partners. And 80% then to 20% split is applied. So the carried interest is 20% goes to general partner, but only after the investors have got their base cost. Let's make some calculations. So management fee is part of the commitment. In this situation, the lifetime fees is 2% multiplied by the total fund size, which is 100 million US dollars, and multiplied by 10 years, which is the term of the fund. So it's actually 20 million US dollars out of the full commitment. So every fifth dollar is expenses, not investments. So only the remaining four are investments. If management fee is not part of the commitment, then the lifetime fees is still 20 million US dollars. Investment capital in this situation is the whole commitment, right? It's 100 million US dollars. So the total capital called during the whole fund's life in this situation actually might reach 120 US million dollars. That's for you to feel the difference. The management fee base often changes after the investment period from commitment capital or committed capital to net invested capital. And net invested capital is quite sophisticated thing. Now, moment. So now let's consider the situation when management fee is a function of net invested capital. I put it here mathematically on top of that. So let's say the realized investments, that's the investments exited or shut down, so actually closed, right, or bankrupt. Unrealized investments, they still exist in your portfolio. The cost basis, that's the dollar amount of original investments, so the money you first initially put into this investment. The invested capital in this situation is the cost basis for invested capital of the fund that has already been deployed. The net invested capital in this situation is the invested capital minus the cost of those investments that were either realized or written off. But consider that still being realized, right? But just negative result. So actually the net invested capital, that's the fully invested capital minus the cost of those which are not in the portfolio anymore. So it decreases with time. And if you charge management fee on net invested capital, with time you pay less. And that's investor friendly. Now let's talk about carried interest a little bit. Carried interest, that's the general partner's share of profits being generated by the fund. Important, and again, very important, that carried interest being paid only on the cash basis. So the carried interest or performance fee should not be paid on the terms of increase in valuation. And that's normal case. So that's normal practice in industry. But if you will be considering, I don't know, some captive things, captive funds or fund of funds, you might get into a situation that somebody will try to charge you on something different. But just again, no cash, no performance. It doesn't matter how high the revaluation of your assets was done. Only after realization. It's usually 20% of profits, but after expenses and management fee in normal situation. So investor-friendly situation, it's when not only the cost of investment itself, but the cost or proportionate part of the expenses and management fee borne is taken into account in calculations. So only after that is back to investors and you still have profit, then it is being split and 20% goes to general partner. But you might be in a situation when, let's say, management fee is not part of the calculation. So it's tricky. It might be not that obvious at start, but if you will put the math together into Excel spreadsheet, you will see that the difference might be quite substantial. There is so-called catch-up provision if there is a hurdle rate. So if we consider the late stage, venture fund or private equity fund with buyout strategy, once the hurdle rate is beaten, all next dollars is being paid to general partner to some point in time, after which the split is continued. So I will demonstrate you later on. It's not that often in early stage VCs, but still for you just to get, there is so-called catch-up provision. It's when the general partner is catching up to the level when 8% IRR is being received by both parties, not only by the limited partners. Remember, there is a hurdle rate. So firstly, money goes and firstly profit goes to limited partners, but then it should go everything to general partners so that they are equalized, and then the remaining profit is being split. And importantly enough, the carried interest might be subject to escrow account requirements. So in some cases, the carried interest of the performance fee might be not paid 100% at once, but part of that can be stored somewhere in escrow account, which is opened only in a situation when the chance of so-called clawback, the situation when the money should be returned back to investor, is very low or zero. Carried interest usually takes two forms, right? It's either whole fund basis, which is very much limited partners friendly, and the second one is deal by deal basis. It's more general partner friendly. In first case, all contributed capital first goes to limited partners. So all dollars invested by investors should be returned firstly. Only after that, general partner can receive capital. It's on a cash basis, remember. In the deal by deal cases, after each successful exit, the general partner distributes capital to limited partners and to himself. And this situation can lead to overpayment to general partner and trigger so-called clawback later on. So every successful deal is very good for general partner and for investment team, right? They are being paid big bonuses, but not all of them. Sometimes you might be asked to return your performance fee. The first case is usually called the European style waterfall. So it's more common in Europe. The second, of course, American style. Americans, they like money earlier. I mean, investment teams. If we look at the same nice picture, we will see that the carried interest is being paid on top of that. So it goes to carried interest. It goes to general partner and carried interest. Let's look at the basis for distribution in this case, the market evidence. Same vintage years, but more or less the same during the other vintages. In venture space, as you can see, It's still mostly whole fund basis. However, it might be deal by deal. So on aggregate, it's the easiest situation. First money goes back to investors, and after that, only after that, the general partner gets something. But as far as you see, I would say every 10th fund is structured differently. So you will have the situation when you have to pay deal by deal performance fee. In other strategies, the picture is more or less the same. And you can find that in buyout strategies, the deal by deal case is the most widespread. Okay, now let's look at the typical whole fund waterfall. First, again, 100% to limited partners, and that's the return of capital. Second, if we have a preferred return, 8%, I'm sorry. If we have preferred return 8%, it still goes fully to limited partners, to investors. Oops. Oops. Sorry, it's. Can you hear me?
Yes, we can.
Okay, but it seems like you cannot see me now, right? Okay, I will double check in the meantime, but okay, I will proceed now. Okay, 8% preferred return goes 100% to limited partners. And it is, remember, it's actually calculated in terms of IRR on those amounts. Only after that, the general partner starts getting his catch up. So he starts getting every next dollar, before he gets actually 20% of the total profit with limited partners. And then the split is being continued. I will try to illustrate that here. So we have the total invested capital and profits. So let's say we have a good fund, good situation. We are happy investors. First and second part, remember here, first and second, that's the cost and initial preferred return, goes to limited partner. Goes to limited partner. Then the third part is fully goes to general partner. And then the fourth part is being split between limited partner and general partner. So first it's contributed capital. Second, I'm sorry, it's a hurdle rate. Third, it's a catch up. And fourth, that's something which is being split 80 to 20. If we don't have the preferred return case, that's the most easiest situation. The easiest, I'm sorry, situation. So first 100%, the return of capital goes to limited partners, and then you have the split. Actually, in the situation when the performance of the fund is good enough, let's say it's 10+% IRR, in the end, you will have the same split both with preferred return and without preferred return. The thing for preferred return is it is really important for only cases when the performance is not that good. It might be a case when general partner just doesn't get enough capital out of the profit. But if the profit is big enough, they will still split it 80-20, even if you apply preferred return. Okay, that's without hurdle in investor-friendly situation. So return of capital is all investments, all fees, and other costs, setup costs, etc. And then you split that. So idea again, all capital back first, then split the profit. Another short example. Let's say we are given that the called down capital was 100 million in year one on investment. The management fee is 2%, so actually the 2 million per year. And the realized capital is 150 million. and in 3 years. So just this simple situation. And let's find the distributions which goes to LP and GP, and let's find what carried interest number will be in this case. Okay, if we have to return back all the costs, we should return first investments, which is 100 million, and all the management fee for 3 years, which is 2 multiplied by 3, which is 6. So 106 million US dollars should go to investors first. The second part is like that. 80% of the remaining part of the capital, of the remaining profit, which is 150 minus 106, and it's slightly above 35 million, goes to limited partner. And the 20% of the profit, which is just under 8 million, $9 million, goes to general partner. So that's the simple math, how it should be split. It becomes more complicated when you have different, more investments and it's spaced during the time, but this is not that difficult. Sorry. Okay. Now let's consider the situation that we have heard of. So in this case, remember, 100% should go to limited partners. Then we have to calculate the preferred return, which will provide investors with at least IRR of 8%. Then the general partner will catch up the limited partners. And if we still have capital to split, we will split that 80-20. Okay, idea here again, all capital back, but minimum required return to investors at first. If IRR is high enough, the waterfall in the end will be similar to the situation without hurdle. But let's look at numbers. Same situation, called down 100 million in year one at the start of year one. Management fee is the same, but hurdle rate is 8%. GP catch up is 100%. When you see the general GP catch up 100%, that's the easiest situation. It's when every next dollar goes to general partners. In some situations, it might be less, but we will not consider that in this case. Realization is the same, 150 in 3 years. The task is the same. Let's find that. So the first step is the same. 106 should go to limited partners, so to investor. That's the cost. And the second is more trickier. So you will have to calculate the preferred return on every investment. So in our case, we have 3 years of investments. So we should apply 8% IRR for 102, which is the cost plus the first year management fee. And then we should do the same for the 2 cash flows in the year 2 and year 3, which is for 2 million in each. And we will get that almost $27 million. That's the preferred return. Just a moment. It seems like, yeah. Then the general partner should receive something after that if we have enough capital. If you do the math, you will get that he will receive $6.75 million US. And it's the equation to check that is that 20% multiplied by the sum of 2 amounts, which is on step 2 and step 3, it should equal to 80 to 20. So that's how it works. A little bit complicated, but actually quite easy. And then we still have some capital, and we split that 80-20. So 80%, which is 8.22 million, goes to limited partners, and 2.05 goes to general partner. Guys, any questions? I know it's not easy to get it at first. It takes some time. Sometimes several questions should be asked, but just let me know if it's not clear. I will try to go through again. What's wrong with my camera? Move on. Shall we move on? Okay, I move on. That's the waterfall deal by deal on a deal by deal basis. The task is slightly different. Let's say we invested $100 in year one in companies A and B and split 60-40. And let's say the company A was sold for 90 in year two. We have to calculate the deal by deal carried interest. And in this case, it's easy. All right, it's 20% of the profit, which is 90 minus 60. So in total, it's 6. Should it be calculated as a whole fund carried interest on a cash basis, there will be 0 carried interest to distribute to general partner. And the reason is simple. Investor has not received full amount of capital invested. Remember, the full amount was 100. And we don't take into account management fee here and expenses, just the simple situation. Invested 100, you get back only 90. Cost is not returned, so no carried interest. So that's the simple difference between the American style and European style situation. So in terms of actual IRR, European style is more limited partners friendly. Okay, and let's move on. Let's take the same situation. Oh, sorry, it seems like that's that's what I've been doing yesterday. That's the same, sorry. Now we're coming back to the next short but topic, but we have to know it. Yeah, that's plus. Okay. Let's talk about corporate governance of VC fund. It's more legal thing, not so exciting maybe to listen, but I will try to be short. It's something you still have to know about. And first of all, no fault divorce. So the general partner who is managing the fund actually, right, might be removed without cause by the majority of limited partners. So this might be a situation when general partner, I don't know, the investors doesn't want him anymore, right? And they vote, okay, get out. And they just say that. They might be removal for cause, and it allows removal of general partner or termination of the fund even in several cases. Usually it's gross negligence of general partner. It's a legal aspect. It will trigger some hearings in courts and etc. Not something very good to be in, but still. They might be also stationed the so-called key person event. Usually there is or there are a key person or key persons who should manage the fund. So investors commit to the fund, but only in the situation when the key persons like key managers or key alpha generators or key negotiators or key track record keepers or makers, they are still in the fund. If important people are leaving the manager, leaving the general partner, the team, it's not the team the limited partners invested with anymore, and they might decide, okay, then I'm not giving you any more money, so just stop the fund. It might be a felony conviction of a key management person. It might be the bankruptcy of general partner. It's quite rare, but still. Or it might be a material breach of fund prospectus. So in fund prospectus, the general partner still has a wide options to act, but he still is limited to some degree. There might be also a situation that, I'm sorry, not situation, but the fund should follow the investment restrictions. They might be stated more or less concrete in this prospectus, but it might be the diversification, or it should be geographic focus or sector focus. So let's say the technology early stage fund should not invest in late stage, I don't know, biomed or healthcare, something like that. It might be the case. And sometimes there might be a co-investment right. It's actually the rights of limited partners to co-invest with general partner. In simplest form, there might be a situation when you are an investor into the fund. The fund is investing, I don't know, in Bumble, if you know that company recently, special dating applications in favor of mostly women. Um, and you, for instance, decided to increase your position. So there might be a situation that you might invest in additional, not through the fund, but directly with general partner. But you have to have good relationships with general partner in this case. Okay, key man clause. It actually covers the key executives playing active role in the management of the fund, right? It triggers in case when they leave the fund, or not leave but start dedicating insufficient time to the fund. For instance, they're not focused on your fund anymore, but they're focused on other things. It's more or less the same, right? You don't have a lot of attention and efforts of key alpha generators into the fund. Yeah, the key man clause might prohibit general partner from making new investment before new executive is appointed. So that's kind of compromise. The fund is not closed, but the fund is stopped before good enough people come to that. The clawback provision, as far as you remember, that's the situation when the carried interest should be returned back. So it required general partner to return this capital to limited partners because the general partner has received capital in excess of agreed profit share. So effective share of his profit is not 20, but let's say 40%. He has to get to return half of that. And the clawback provision ensures that situation. The general partner doesn't receive higher share of profit. Normally, the situation is that the clawback is due on termination of the fund. So actually, in the worst case scenario for limited partners, that might be a situation that the carried interest on a deal by deal basis is being paid, let's say, in year 3 or 4. Then you have your fund. In the end, it is not very much successful, and there is a clawback provision, and the money should be returned to the limited partners, but they will be returned only, remember, after 10 or maybe more years of the start of the fund. So actually in 6-7 years or more after they were actually paid to the general partner. So on IRR basis, you are not very it's not very friendly for you. And remember, if general partner has paid taxes on his carried interest, he will return capital to limited partners without that taxes because it is already in the tax authority account, right? That's another problem. Okay, disclosure and confidentiality. Information on portfolio companies should be used by LP only. Right. Usually, limited partners will get regular LP reports on a quarterly basis, most often, and on performance of the fund. There might be substantial information on companies themselves, but it will be still management summary. You will not get detailed information on the companies. If you're an investment in the fund, you will not get detailed information on the companies which in the portfolio. Distribution mechanism of, as far as I remember, the waterfall, it provides you two types, either deal by deal or whole fund basis. Deal by deal, remember, earlier distribution to general partner, less investor friendly, more common for buyout fund. Whole fund basis, again, much better for limited partners. General partner receives carried interest only after the limited partners get everything they should. Okay, it seems like we have to make a break now, and yeah, let's then close to 11 a.m. we shall proceed, and we will consider the typical investors into the venture funds, and I will show you the map of the space. We will see several names of investors and funds. So see you at in 11 minutes at 11 a.m. Okay. Okay, let's proceed then. Now we will consider the typical investors into the venture funds. There are many of them, but among them we have biggest and largest universities via the endowments, of course, corporate and state pension plans, sovereign wealth funds, the big chunks of capital, as far as you know, they also invest in venture funds. They have portfolios of those. Big life insurance companies, as far as you know, these are one of the long-term investors, and they are fine with investing in illiquid space of private capital and venture industry in particular. It might be also U.S. insurance depository institutions like bank holding companies, other banks, and that's a lot of other companies, and of course not non-US as well. Fund of funds investing in different strategies and sub-strategies are of course also the investors into the space. And private foundations, endowments, and family offices. I'm not sure if they're here. Yeah, of course. And the individual investors, quite wealthy ones, they might invest, and actually they invest. It's quite often to invest through private banks. Let's say the UBS, Credit Suisse, or JP Morgan, or Goldman Sachs. They have private banks arms, and it's not that difficult to get an allocation into particular funds through so-called feeders. So they put together those high net worth individuals into one vehicle, a legal vehicle, and they participate as one name investor into particular funds. Okay, now let's look at who is who in this venture capital industry. If we look at the managers 2 and 3 years ago, 4 years ago, we see that the number of active fund managers location, it's of course, first of all, United States. Second, even at that time, was already China. The gap decreased even further in the recent years. And then, of course, UK and other countries. Interestingly enough, on the left side, you see that the vast majority manage only one fund. Some companies manage from 2 to 3 funds, and there are some managers who manage 3, 4, 5, even 6 funds almost. So they might have sub-strategies or sub-region funds, and etc. So of course they will be different teams and different names of the franchise. Yeah, and that was actually the difference I wanted to demonstrate here, that the picture of distribution hasn't changed enough. But you see, even in 2017, the gap between China and US was only four times. But in 2016, that was almost 7 times. So China was picking up and is still picking up a lot in catching up in that space. If you look at the preferences of venture capital fund managers, the industry preferences, you see that the information technology was the number one. It is still the number one. The healthcare was already second at that time. After the COVID, for sure, as far as you get, the healthcare is becoming more popular. But telecoms and media and communication was also of interest. By investment stage, of course, a lot of managers, they invest in early stage. And there are still enough managers who actually invest across the stages. The situation doesn't change a lot from year to year. So, but at the moment, it's more or less the same as well. If you look at the top general partners, top 100, 4 years ago, 224 billion US dollars was the aggregate capital raised by those top 100 venture capital GPs for the last 10 years at that time. The majority of them was based in US, right? And the dry powder, when we say dry powder, remember it's commitment, which is still has not been called, but it can be called for deals. So 1/3, to be roughly 1/3 of the capital was not deployed yet. If we look at that. This is the map of the top general partners. Even 4 years ago, that was already, of course, North America #1, but China was already #2, not Western Europe. If we look at the fundraising by top 100 venture capital general partners, we will see that the number of funds closed, of course, was the biggest, and again, North America, but again, China was the second one. If we look at the distribution of capital, we see that there is a concentration. So the biggest funds, they raise the largest funds and get the share of capital. So in terms of the funds, you see that 117 billion was raised by the top 25 funds only. These are the names which some of you might be familiar with already, some not, but now you will get that. So Tiger Global Management, New Enterprise Associates, that quite big guys who's playing in this industry. Sequoia is one of the most, I would say, good performing managers in recent maybe 20 years. 10, 20 years. DST Global is, as far as you know, it has some Russian roots, but still it's a global company. Remember Kleiner Perkins, which the company I named at the first lecture. It's also one of the biggest players in terms of capital raised. Anderson Horowitz, Axel Partners, Index Ventures, Lightspeed Ventures. To be honest, it's very difficult to get into the funds of those managers at the moment, even through good allocators. So when I say allocators, there are intermediaries in the market who can help you to get into the fund, or who can run some kind of private equity programs for you, including venture capital and private equity. And even through them, having good relationships with those managers, it's quite difficult to get into. So the reason is good funds of good managers are being oversubscribed many times currently, and they can decide who to take in and who not to take in. This is the longer list of companies, of managers. If you look in the middle, you will see some Chinese companies already here, and etc. If you look at the most globally active, not in terms of money, but in terms of number of deals, which might be small, of course, as far as you get, the names differs a little bit. You will have 500 startups and Sequoia Capital at the top of the table. But as far as you see, Lightspeed Ventures is still here, IDG Capital is still here, New Enterprise Associates is still here. And these two, actually, they're not funds, they accelerators. Accelerators, that's the vehicles which actually collects a lot of ideas, and they take those entrepreneurs, early stage entrepreneurs on board in batches. So every maybe 4 months, they're on programs. They help them to organize their business, to set up the companies, to get to know how to sell the product, how to find the product market fit, and etc. And they, in exchange, they get the shares in those companies. And then at the end of each batch, they have so-called demo days. And during that demo days, other investors are present. They listen to the pitches and they decided whether to invest. And some of those companies actually get funded by fund managers and VC players. Of course, the capitalization, let's say the valuation of the companies goes up after each round. And those accelerators, they actually capitalize on those efforts they applied at the start. Quite interesting model. Actually, 500 startups has not a joint venture, but some kind of collaboration with Sberbank in Russia. Maybe for the last 3 years, they had this startup accelerator program in Moscow. and it's not that difficult actually to visit that as a visitor, and you can listen to some pitches. Um, and I would recommend, highly recommend, if you have an opportunity to do so. It will be not, of course, during the weekend. It will be the working day, but it's highly recommend to visit at least once, just for you to get the flavor how it works. What are the most promising? Maxim is asking the question. What are the most promising VC funds in Russia from your point of view? DST, but DST it's a global company, it's not Russia. RTP, Runa, yes, these are the good names, I would say, but still all of them are investing internationally for many years already. And there are many reasons to that. Russian market is not only small, but it's not increasing, not developing. The problem, there's a big problem with exit here. And after the devaluation, we'll say how we call that, yeah, decrease in value of Russian ruble, and change in consumer economy, most of the funds has switched their focus to other countries. So they're not focused only on Russia, but there are good opportunities for investing into some Russian companies with the potential to go outside of the country, and all of asset-light things in technology, and in particular spaces like healthcare, health tech, insurtech, I would say, maybe fintech as well, but not exactly now. They have some potential. But in terms of, if you consider that, Maxim, I need more context, but if you consider that in terms of you working in those funds, for sure, I would consider RPT, yeah, Rona as well, but it's quite specific one. Yeah, as a nice idea. Any company to work for, to get experience will be worthwhile doing. But for you and me, promising means different things. And actually, I get used to think of the industry globally, not Russia on the original. To be honest, I don't care because when I consider global portfolio, I know that there are global managers there. But if we go down, yeah, RTP and Runa are good names for sure. Now let's look at the limited partners, the biggest limited partners. So if we look at the structure of top 100 venture capital limited partners by type, we see that the pension funds is the vast majority of that. There's also the private equity fund of fund managers who allocate money across different managers. We have also private sector pension funds, and it might be foundations and endowment and etc. Right? As far as you see at the top left corner, the average number of fund commitments made by the biggest capital limited partners, it's 28. So in simple words, you will have 28 funds in your portfolio. So just for you again to understand the idea, it's a couple of dozens of funds in your portfolio. So you should be thinking as a big limited partner, big investor in terms not only particular fund or even particular company. You don't care about particular companies. You care about particular managers and their part in your portfolio and their ability to generate return on consistent basis. And the majority of biggest limited partners, of course, is the United States. And half of top limited partners actually open to invest in first type managers and the so-called spin-off venture capital funds. Spin-off venture capital funds, it's the situation when, let's say, a small team from RTP or Runa, they spin off and make their own fund, and they actually ask money from you into this new team and new fund. They know how to do things, they know how to invest, they have experience, but the franchise is new, and you can either invest or not. That's a normal case. It happens everywhere in the world across the different strategies. It happens in private equity, in venture funds. It happens with hedge funds. So talented managers that don't want to work for somebody else during their whole life, they usually try to start something on their own. And those people familiar with the industry, I'm not considering myself a lot to that, but there are people who are deep into the industry. They know who to follow. So if for us, a new name will mean nothing for allocators, for top investors. Particular new names will mean that that's just the same good, really good team, which was in another franchise, and now they have their own franchise, and they most probably will invest maybe lesser amount of capital, but still they will follow. And usually they will get better fee terms, fee schedule, maybe less management fee, or I don't know, some other preferences. Okay, if we look at the top 100 venture capital investors by location, here we see that the majority in North America and Europe, which is interesting enough, right? If you look at geographical preferences, then actually across the globe, but what you can see is just Africa, Middle East, and Latin America is not so popular as North America, Europe, and Asia, and even emerging markets. And 4 years ago, that was venture debt was not that popular. It's becoming more popular, but of course, that's not the majority of the market. If you look at the names of those top limited partners, you will see that most of them are either pension funds or fund of fund managers. You have also endowment plans here, but still it's not all sovereign wealth funds. But these are actually big institutional organizations, right? It's big institutional organizations. It's not family offices. It's not particular rich people, etc. So that are the names which actually find investing either their own money, but usually other people's money as well, for long-term periods. Okay, now let's look at the one good picture of how to choose the good fund manager, and that it is. Actually, you have to look at 4 main pillars. It's the team, it's the strategy, it's the investment terms and fit, and market dynamics. When we talk about team, we should ask ourselves whether general partner has good enough skills and expertise in particular field or niche. How stable is the team? How cohesive is that? What are the alignment of economic interests with this team and inside the team as well? It's actually quite important to understand what is the motivation, the alignment of interest inside the team of the manager. Otherwise, you can have a lot of rotation into the team, which actually will not benefit the performance for sure. And you have to look at the track record, both not only at fund level, but at the partner level as well. And here you will get understanding who is actual key person also, right? Usually in each fund, there is 1 or 2, okay, there are several people who actually either gets most of the pipeline or provides most of the performance, positive performance of the fund. And it's difficult to know these details, right? To looking only on IRR multiples. So that's why there are particular players into the market, allocators or gatekeepers, who know a lot about particular managers. And if you're not very familiar with the industry, or you're not in the center of the universe, you better use abilities of those companies and players. The strategy of the fund should be clearly differentiated among the peers. And it's good if the company or the fund manager, right, has some unfair advantage in terms of sourcing opportunities. I don't know whether it's relationship wise or somehow else. I don't know. The idea is that they should be the first or among the first who the good opportunities will come to firstly, right? And that's actually the venture space. Good opportunities are not somewhere in the public as a public information available. It's like everywhere. It's the relationship market. And you also should understand how the portfolio is being constructed. What is the plan actually? And what are the target returns, etc. If you look at the investment terms and feed part, here you have to to see how your investors' economics aligned with the managers. So, what is the fee schedule? What is the carry interest? Who are the key person? Remember, team, you have to know a little bit about that. How clawbacks actually works here, and what is the waterfall? Interestingly enough, but it's on your side as an investor to understand how this particular fund manager or fund or strategy fit into your total portfolio. What is the role of that? It's not the pain, the head pain of the manager. He has just to do his job. But for you as an investor, you need to understand why are you going into this particular strategy or with this particular manager. And of course, timing of fund closing is also important. You have to understand the pacing when the fund will be closed, or whether it will be this vintage year or next vintage year. And actually, historically wise, how was the capital drawdown done? Whether the manager was fast or usually slow, or was he fully invested or not even fully invested? Okay, it's quite important to understand how his pacing of an ability to take your capital and invest. And the last one is market dynamics. You should also get familiar with the market, and you should understand that the strategy of the manager or the fund, how it aligned with particular macro drivers or opportunities in the universe. For instance, currently biotech, healthcare related things are becoming quite popular. But of course, travel and leisure are not that interesting topics currently anymore. But 7, 8, 10 years ago, I would say maybe globally 10 years ago, maybe 10, 11 years ago, the travel, the tech was a hot topic, but currently not. Currently not. And I'm not sure whether it will be anymore. Funds brand recognition and ability to attract investors, again, that's very important for you to understand. Who will be, whether your manager will be among the first who will get the opportunities, whether another good manager will call him to take on board and co-invest together or not. That's quite important. It's all about getting small number of good opportunities in your portfolio. You usually cannot do it directly. It should be done by managers, and managers should be able to get those opportunities. And competition from other funds, of course, should be taken into account. So a lot of aspects to take into consideration. So even on the level of limited partner or on the level of investor, there are a lot of things to think about and to know about and actually to track, even without going deeper down to particular subsectors, industries, and etc. So it's a multi-layer industry, and you should do your job on your level, right? If you're a limited partner, you should do your limited partner's job. If you're an investment manager, you should do your job on the level of managing and finding opportunities. Okay, now we are coming to the quite important aspect, the so-called J-curve. J-curve is the situation when your returns are negative during the first year of performance. So it works like that. So the stage on the company life cycle, right? If you look at the company, let's look first at the company. So early stage, there's no earnings growth. The company is consuming money, consuming capital, trying to make something out of that. There is an expansion on late stage venture capital case, but still before the company start expanding rapidly and actually gets into the territory of growth capital or later on buyout strategy, it has negative cash flows usually, right? And same situation happens with the fund, because the fund actually invests into particular companies. And more to that, you have the fees, right? Remember, management fees, setup fee, other expenses, and etc. They're being paid from day one. And the situation is the following: you have actually cash outflows during the first years of the fund's life, while the cash inflows will get to you only closer to the second half of the fund's life. So the first part of the fund's life is actually the portfolio construction period, right? There is also the value creation period when you still continue working with your portfolio companies, trying to increase their value by different things, and start receiving some capital out of that, starting to, I don't know, divesting or selling or exiting the companies. And on an aggregate basis, your fund will have this almost green-yellow line case, right? And it characterizes your internal rate of return. Given that at the start you will have only money outflows and no upside in valuation, usually you will have your investments in venture capital fund at cost, you will be underwater and your IRR will be negative. More to that, you will be paying management fee and expenses, and it will be going down even further. So actually, it will go positive after some period of time. It might be quite different. Recently, it shortened because the valuations pop up quite significantly. It was much different after the dot-com bubble, and it also depends on the strategy at all of the private equity or private capital fund. But for you in aggregate to get the idea, you first pay money, you first have negative IRRs, and to make any conclusions, you actually have to wait several years. Usually at least 5-6 years. It's so closer to the second half of the fund's life, it's when you can start making any conclusions about the result of the investment team and the fund, particularly. So if we put that in thesis, we will say that in early years, venture funds, call capital, and invest have negative cash flows. Of course, investment returns are negative due to management fee. Right on the investment level, you will have zero return because you have invested, let's say, $100 and you value the investment at $100. So on the level of investments, you're zero. But if you put it together, take into consideration the costs, it's negative. Interesting situation that lemons ripen early. So non-performing companies usually manifest themselves close in time to initial investments. So most often, good companies will be on your balance sheet for longer periods of time and then maybe finally pop up in valuation, while the bad investments will show themselves earlier in the stage life. And this actually adds into this J-curve effect, because if you invested again another $100 US into the company and you write off it in 2 years, it is a negative impact on your fund, right? So the J-curve actually exacerbated by these non-performing assets. Again, it can take several years for the portfolio evaluations to reflect the efforts of the general partner. Over time, importantly, the progress is being made. The company is becoming more successful. Their values is going up. Usually venture companies, they actually attract several stages of fundraising, Series A, Series B, etc., etc. And in normal situations, the valuation goes up. So with new rounds of financing, most probably your stake of your valuation to the company will go up. It will be diluted, but it will still go up. And you will start receiving so-called unrealized gains. Because they are unrealized, remember, no carried interest can be paid yet. In the final years of the fund, the higher valuations, they confirmed by partial or complete sale of the companies. So actually, you finally have exits and cash flows to the partners. And this is when the carried interest is being calculated unpaid, if we talk about the whole fund basis, or even the deal-by-deal basis, but it will be just on the deal-by-deal basis. So that's why this period is called the harvest period, right? Venture fund harvests successful companies, harvests results, harvests returns. Again, venture funds, just some key takeaways, should get better with age, as many of the private capital funds. So with time, your performance numbers become better and they start making sense. In practice, as far as you get the private equity portfolio, whether it's a buyout or venture and etc., it actually involves a series of G curves, right? Because the fund invests on different times. And remember, if you have a portfolio of funds, not all funds will be profitable, right? There might be different reasons to that, but for you just to remember, there are other effects on performance. This is not very high resolution picture, but this is how you should look at the situation. So starting investing, your returns goes down, actual returns, then they goes up, but you can consider them as being smooth band. Maybe starting from sixth, seventh years, there is a sense to making any calculations and conclusions on performance. Now let's evaluate qualitatively some fund performance. So first of all, let's look at the different asset classes. And as far as you get, the returns usually increase with illiquidity, I'm sorry. And especially today, right? Deposits of global government bonds will provide you close to zero, in some cases negative returns for sure. There is no sense in making investments in government bonds at the moment. But with holding period being longer, your expected returns go up, right? And the private space where private capital, venture capital, private equity, and etc. The expected returns are higher. Doesn't mean that the realized returns will be also higher, but the expected returns are higher. And now let's touch on several important metrics of fund performance. And first of them is PIC, which is paid in capital. Paid in capital, that's the total capital that was paid into the fund, and it is divided by committed capital. And actually, it shows you the proportion of capital called by the general partner from your commitment, right? It tells you, let's say if it's 0.5, it means that half of your obligation is already fulfilled. You have provided 50% of the capital which you legally obliged to provide, and the remaining part is also 50%. There is another multiple called DPI, which is distributed to paid in. It's the cumulative distributions, all the distributions paid out to limited partners from the fund as a proportion of cumulative invested capital. So actually, it shows you the cash-on-cash returns without any IRRs. And it shows you the realized return on investment. There are two other multiples: residual value to paid in and total value to paid in. So residual value to paid in is the value of limited partners shareholding in the fund as the proportion of cumulative invested capital. So actually, this part, RVPI, is an unrealized return on investment, right? Remember, DPI is realized, RVPI unrealized, and TVPI is total value. It's realized plus unrealized. Actually, in this case, vice versa. And it's net of management fee at carried interest. Let's look at the example. Investor has invested $150 into best venture fund with a size of 200. His size, right? Let's consider that. The fund has distributed 100 net of carried interest, and the current portfolio value is at 150 at the moment. And let's consider the situation we don't have any fees. Can somebody tell me what is the paid in kind multiple in this case? Again, I will just revert back. It's the total capital paid into the fund divided by the total commitment. I will be glad to hear any answer at the moment. Right here, like chat more. When you answer the questions, please don't put the mark of the question after that, Victor. But okay, thanks for providing. You are the first among the people trying to get that. Guys, maybe any other answers? or you don't want to calculate yourself? Okay, let's move on then. Yes, you are right. Thank you. And what about another multiple? Is distributed to paid in. Again, distributed to paid in. It's cumulative distributions, so all distributions received divided by the capital invested, not committed. Victor has already answered. If somebody else will answer the second question, that will be much better. Victor was the first, but okay, thanks, Maxim. Let's look. Yes, it's roughly 0.67. Okay, then it should be quite easy for you to calculate the two remaining: residual value to paid in and total value to paid in. Please feel free to make it in a chat or by voice. Okay, let's proceed then. It's 1. Right, you have invested 150 and the value is 150. So 150 by 150 is 1. TVPI, as far as you remember, it's ERPI plus DPI. It's 1.67. So these are the numbers which shows you that the most of your capital has been already called into the fund. Actually, every $2 out of 3 invested already has been returned to you. And you still have 1x on your investment into the fund. So your total return, both realized plus unrealized, is almost 1.7x, which is quite high, I would say. Okay, now let's look at how the general partners value the portfolio companies. And the easiest way, usually at cost. There might be some adjustments for subsequent financing events or deteriorations, but still, once you have invested and without any other major cases with your asset, you just value it at cost. Sometimes it might be either at lower cost or market value. So some conservative players, not a lot of them, but some names, they value the companies still at cost, even if there was several or one at least rounds of financing with increasing valuation of the company. And this is another point to note when you consider and comparing funds among themselves, among the peers, right? Some of the peers are more conservative rather than the others. And some fund managers will be showing you like still J-curve or I don't know, the cost instead of value. And only when you realize that, you will see that the portfolio actually was really good. That is also possible. So keep in mind, not very often, but that is possible. Don't forget about that. So, and the others, as I talked, say they just make their evaluation at every new financing round when there are new investor stakes, importantly. So if you have the third party evaluation, it's not you again who keep investing into the company and only you, and you just increasing the value of the company. No, it should be somebody else. Third party evaluation is a very important aspect in all the private deals, not only in venture. And it might be at cost, and that's it, as I told you already. Sometimes they might be marked to market by reference to a peer group of public companies and applying the liquidity discounts. That also possible. So again, it might be differently. Keep that in mind when you make judgments about different fund managers and results. This is the summary slide from INSEAD paper. I will send it for you to you. I will make it during May holidays. But for you, it's important to understand that there are actually 3 levels at which you can look at the venture investment. First of all, it's the individual transaction level. So actually, there is a target company, and you can make any judgments on success or unsuccess of these investments based on the valuation and all the outcomes with this particular company, right? So it's important to know the valuation methodology. It's you can make any judgments on risk return, you make scenario analysis, you make evaluations. That's closer to that most of the job here is like IB or investment type of the job. Then you should know how to understand the metrics on the portfolio level, right? So on the fund level, you have several target companies in your fund, right? And there are other things to understand, that you have both realized and unrealized things. You might have some illiquidity discounts. And here it's important also to know what is the IRR of your fund now, and what is the money on money multiple. And there is another layer which is on top of that, right? It's then you have the portfolio of different funds on the level of limited partner, on the level of investor. And here you might have different types of IRR, right? It might be, it's important to understand the gross IRR, the net IRR, the money gross and net money multiples. It's important to understand what is the management fee you pay in total for your portfolio and to each manager. What are the different carried interest structures, where you have hurdle rates, and how you should benchmark each of the funds, given that they might have different locations, different strategies, different vintage years. So a lot of aspects to keep in mind when you talk about returns and success, right? It depends on what level we are. And here's another illustration. Like on the fund level, we see that we invested, let's say, in companies from A to G, from different industries in different period of times. This is called this investment schedule or schedule of investments. You most probably will see something similar in many limited partner reports provided by the funds to the investors. So you will have the date of the investment, the industry, the name of the company, total investment amount. You will see what part of that is realized and what part of that is unrealized. So the total value will be realized plus unrealized, and you will divide that by cost to get the money on multiple. And of course, there will be a gross IRR, but gross IRR, of course, by particular investment, right? And you cannot average them somehow, because you have to pull cash flows together on the fund level to get your IRR on the fund. And it doesn't depend on the IRRs of particular companies. So you cannot deduct, you know that, I'm sure. I will not be staying here for a lot. And you see on the right that there might be some background. You will see that the company, the exit year was 2008. It was the buyback exit, or it was a trade sale, or the company was written off or made an IPO, and etc. etc. And remember again that IRR has some assumption that the capital being reinvested at this IRR, which is always not the case, right? There are other IRR concepts, which is modified IRR, etc., zero-based time IRR, neutrally weighted portfolio IRR. So mathematically, there are a lot of things to do to tweak around. Maybe not something to do often, but just keep that in mind. It's quite complex, and there might be some nuances to know about. And this is how we should look at the cost of our net returns. So the situation is simple. We have the fund size with the standard term. We have the fee schedule. All right, we pay on commitment during first 4 years, which is investment period, and the management fee is less. So I forgot to tell you that it might be 2 cases how you pay management fee after the investment period. It's either the changed base, which is decreased on the capital, or it might be the same base but lower fee schedule itself. So in both cases, it's more investor friendly. It's European style structure of carried interest. And simplifying the situation, we see that on a gross level, we invested in 5 companies like equally. Then in 5 years, we realized each of them with multiple 2. It's a simplified example, but still, you now see at the bottom that there is a management fee and there is carried interest amount. And now you can see the big difference. So the total gain on a gross basis is actually 200, another 200, right? So the multiple on the fund level on the gross basis is 2, and your IRR is close to 19. But if you consider not the fund, but you as investor, and take into account the fee schedule, even in this simplified example, your gain decreases significantly, right? Your money multiple decreases significantly as well. And your actual IRR is much lower. It's slightly above 13, right? It's not almost 18. So 5.5% almost. And keep that in mind. This is how venture and private and most of the private capital fund work. It's not cheap. Let's look at the example of portfolio math. Now there is a correlation ventures. They made a study. They decided to look at many particular rounds of financing and businesses. They took more than 20,000 financings and they looked at how the companies finally exited, and they made a map of outcomes. And as far as you see, 2 out of 3 investments will not get your money back. Most of those in the bucket 0 to 1x is actually flops, so you will have 0. Some of them will give you something back, but still, it's those who will lose your money. You will, every fourth will give you multiple, again, on a gross basis, right? We're talking on a gross basis on the fund level here, just investments themselves without the schedules. So you will get good multiples from 1 to 5x, and you will have decreasing the smaller amount of companies providing you much better outcomes, right? So to have an outcome of 20 to 50x, it's statistically at that period of time, that was roughly 1%. Okay, it's like 200, I don't know, 250 companies only. And here I want to show you how Peter Thiel is thinking about that. He's quite famous in venture space, interesting person, and I highly recommend you to read his book 0 to 1, just to get the flavor of venture investments without a lot of numbers. The biggest secret in venture capital is that the best investment in a successful company actually pays out the whole remaining fund. So those successful managers, usually they are successful enough, either lucky or skillful, nobody knows. Let's consider skillful. But they have 1 or sometimes even 2 very good investments into the fund. And that's why they're successful. And those 1 or 2 good investments, remember that those 2 investments which goes into your pipeline, usually like only in a good network and with good relationships. And here I want to show you quite important topic of power law distribution and compare that with normal distribution. As far as I remember, the normal distribution, it's a bell curve, right? It's highly used across the finance topics. Not the best case, but still much easier to analyze. And it says you that you have the mean return and you have some dispersion around that, and the bigger the dispersion, the less the chances of getting that return, either positive or negative, right? And if you look at the power law distribution, it's actually the yellow one. It's the curve which shows you that the vast majority of outcomes has negative returns, right? Close to minus 100%. And with increasing return, the possibility, which is on the vertical scale, is decreasing. But interestingly enough, here, you have the right tail. You see that to the right, there is a small but yellow tail. And this is the place where you have huge returns. Yes, with low volatility, but still it's the chances of getting huge returns are higher than under normal distribution assumptions and even student distribution sometimes. So to be honest, venture in the industry, it's all about this tail. It's all about trying to get at least one outcome from here. If you get more, it will be perfect, but at least one. And here are some takeaways. Small outcomes are very likely, right? Small, which means that you will get close to nothing. Large outcomes are much less likely, to the right tail, right? But still, small number of inputs account for a large percentage of outputs. And you have very fat tails compared with the normal distribution, especially the left one, but the right one as well. And importantly, again, one good investment might compensate you for the rest of your portfolio, as Peter Thiel is saying. And now mathematically you understand why. Again, success of the venture funds depends mostly on the number of really great investments, guys. It's not the portfolio stocks of companies, which mostly will provide you returns from 5 to 25, and on average you will have 15. No, it will be one with, I don't know, 1,000 returns, several with +5 returns, and most with -50. And remember, most venture capital investments fail again. If you work okay and very tiny succeed a lot, statistically, you have to make statistically wise, right? You have to make a larger amount of investments to get at least one unicorn or at least one from that right tail. And there is that's all puts into one into the rule of thumb. Venture investors try to invest on average, right? They keep that in mind. They try to invest only in companies. Sorry, I have to answer this. Sorry, I'm here again. So there is a rule of thumb. They invest only in companies that have a potential, at least a potential, to return the value of the entire fund. So there is no sense in making an investment statistically wise into the company which doesn't have enough potential to pay out your return, your fund. And that's one of the reasons why Russian venture funds switched to international market. Because to get the investment in Russia, which has a potential to pay out your fund, is going closer to zero. It's very difficult, but it's the chances are much bigger outside in the global market. And actually, it's not only with Russia; it's elsewhere, right? Actually, the VC space is becoming more internationalized. American funds investing in Europe and China, Asia particularly, a lot, as well as non-American funds, both European and Asian, are investing in America. And I will try to demonstrate you how it works. So let's say you have the frequency of loss. I simplified that a little bit, but you have the frequency of loss when you get zero return, so -100% return every second time. You get something, okay, half of the money invested in every fourth situation, right? You have small win, so you have 3x in, I don't know, 18%. large wins of 15x in 5%, and unicorns, let's say when you invested on early stage, and one out of 50 companies will provide you 50x on your investment, which is of course very rare. So theoretically wise, if you have infinite amount of capital and attempts, you have to get theoretically the multiple of 2.42, right? It's just mathematical. Now let's look at it if you have 15 investments into the fund, which is actually quite often when you have that more or less the same. So if you round that, it seems that the actual fund return, statistically wise in this case, less than 1 on a gross basis. So you should be lucky to somewhat to be at least in a large win or unicorn. So you actually losing money in this situation, statistically wise. If the number of investments is higher, again, we leave in all the rest remaining, just same frequency, same statistics, outcomes, etc. And we just round the numbers to the right. And in this situation, statistically wise, you will get more from the portfolio of your investments than you invested. But still not that high, right? If in 10 years you get 1.23 with average holding period of, let's say, 4 or 5 years, I'm not sure it's a good investment option. Maybe it's easier just to, I don't know, to buy Russian bond, which you still can sell even now. If you increase your number of investments to 100, you get your theoretical multiple. Of course, to have 100 investments into the fund, it's almost impossible, just resource-wise. Even if you have not small but medium team, to get enough investments to have 100 investments in your portfolio, it's very, very difficult. I'm not sure it's even being done somewhere. But just for you to get the flavor, remember, if you invested in one company, you have screened maybe 1,000, and you made due diligence of dozens. Even if you have enough team, most of your resources will be spent on that. But it's only part of what you have to spend your money on. Remember, there is a huge chunk of money which you should spend on working with portfolio companies where you have already invested, right? Observing, changing, helping, attracting maybe people into those companies, helping founders, etc. So to summarize, it's not that easy, statistically wise, to get good returns in venture space. And here's one of examples. There is a good website called Seraph. They mostly talk about angel investors, but I highly recommend to visit them. But still, they have some Excel spreadsheets just to play with. I try to do that. They have slightly different classifications. They have loss-making, break-even investments, base hit, home run, and grand slam. You see it to the right. And let's say you have a fund, the total amount invested 100 in all your companies on the gross level, right? And let's say you have returned 2.5x. It's really good, right? It's really good, 2.x. Let's say we deduct the cost and management fee and carried interest. So in this case, the net multiple will decrease to 2.21, and your implied IRR for a period of 5 years. So let's say you sell every your company in 5 years. So I just tried to simplify that. It will be 17% IRR. Not 25, not 40, not 100. It's not Bitcoin. But it shouldn't be, of course. But I hope I provided you with some mathematical things to better get the flavor of the industry. It's okay to think about that from time to time. There might be huge investments, let's say Facebook or Google or Amazon, right? But it's very rare. It's very rare. But everybody wants that. The industry is working because from time to time you might get that types of investments. Okay, now let's cover the returns in venture industry a little bit from the different angle. Remember, we covered that at lecture number 1. At that time, we saw that the risk reward ratio in venture space was the worst among the private capital. It changed a little bit later on. I showed you, but just for you to remember. This is another source of information, PitchBook, which I told you about. And it shows you that by vintage year, the median IRR of the venture funds was by blue line. Let's say 2013. Okay, in 3 years, remember, it's still in the early stage of the life. You still should account for that. But let's say in 3.5 years from the start, on average, median fund was demonstrating its double-digit IRRs. But still, there were funds demonstrating much lower and much higher numbers. And of course, they should be the worst and the best fund. But it's all about the funds which are in database. If you look at spread between percentiles in private equity and venture space, you will see that those spreads are constantly changing. So the dispersion is not constant; it's moving. But for you just to get that the spread might be double digit as well. In terms of IRR, remember, in terms of multiple, it actually substantially changed the whole outcome for you as an investor. Here's an important, very important picture. It's the average distributed to paid in multiples, which we covered recently, over time by vintage years. So as far as you get, it fluctuates, but you can see that, let's say in 2005 and 2006, even after 10 years, so closer to the fund's life end, the funds have not returned the cost. It means that they might have a lot of value and unrealized value, but that was right before the financial crisis, right? And I'm not sure that most of them have realized that. For you just to get the flavor that in 6 years, on average, in 5 to 7 years, you maybe will get less than half of your cost invested into the fund. So you will be still invested heavily into the fund. Your unrealized value might be substantial or not that substantial, depending on the manager and his success. But cash-wise, your money will be still frozen into the funds. And again, this total multiples, this is TVPI, right? And you see RVPI, DPI, and TVPI. And it says that even for the funds which are closer to the fund's life end, still the capital is not distributed, wholly distributed. So this is median. Of course, half of the funds are better, but remember, half of the funds are worse. And we're talking only about the funds which are in the database. There is a huge amount of funds not in the database, and nobody knows about their results. I would assume most probably they have worse results than better. Because if you have better results, you will be inclined to tell about them to attract money, right? Here's a good example of the funds of US VC funds of the size between $250 million US. They're quite big funds, not huge, but not small, of course. And this was the best performing funds according to PitchBook. But what I wanted to show you here is IRR might be high enough, but your distribution might be even zero. So actually you might have no realized returns into the good fund. Most probably, you will have some realization in the coming years. But just to you to get the flavor, of course, it's much better to have the fund with high IRR, but DPI multiple higher than 1. It means that you have already realized all your costs, and most probably with some return, and you just have a free option as an investment into the fund, right? In the last case, with this domain partners 8, you are still fully invested. Yes, your IRR calculation is high enough, but it's all unrealized, so you still bear the risks. It doesn't mean the fund bad, but just for you to know that, understand. So if you might have similar IRRs, but it's all about whether you have realized them or the manager have realized them for you or not. If you look at smaller fund size, you will see more or less similar picture, right, in terms of IRR. Now I wanted to stress some interesting small things, but for you just to keep them in mind. When we talk about the multiples, and here we have the table from another source of information, which is Preqin, Private Equity Intelligence. And here we see that if we took the vintage of 2007, and that was done in 2020, maybe last year, it should be done last year, we see that the median multiple is 1.63 of the funds which should have been realized, right? And if you look at the IRR, of course it's by quartile, but you will see that it's slightly less than 10 IRR. And let's just make the simple math. Let's say we have the fund's life 10 years and IRR is 9.5. Let's just try to conclude what the multiple should be. And it should be 2.5. But it's only 1.6. Of course, there are some nuances here, but still you get this picture, right? It's much lower. If you pull that together, it will be different, but importantly to know, as you are not fully invested in any type of private fund, including venture fund, you are not returning your IRR on the full amount of the capital you are subscribed to. So you will be providing capital in pieces throughout time and getting back money in pieces throughout time. And IRR is quite sensitive to timing of cash flows, right? And that's why we have the situation when you cannot come from IRR to the multiple, because actually on every stage of the fund's life, you are just partially invested. Your effective exposure to the fund's risks and fund's ability to get your money to make money for you is limited. All right, and it's a big difference actually. That was the question. If you look at the pooled benchmarks, so what they've done, they took all those funds together, right? Here, the reason might be that we are calculating quartiles of multiples and IRRs differently, so the subsets are different. But let's just take all the pooled numbers. They claim, Preqin claim they have this. Let's suppose it's true. In this case, your pooled IRR is higher. So actually, best performing managers most probably had higher chunk of capital. But still, multiple is 3.6 and twice larger than the multiple as a weight on the weighted fund. That's for you, just keep in mind. Even if you are claimed to have 15% IRR, you might simply calculate that your multiple will be close to 4, but your actual multiple will be under 2. Because in every period of time, you will be only partially invested into the strategy. And even if it's a good strategy, it will provide you decreased amount of exposure. And here we have so-called oversubscription and overcommitment thing, which usually is recommended. If, let's say, you want to have an exposure to private equity or venture capital strategy of, let's say, $100 million, you actually have to commit more, maybe 150 and etc. So sometimes 200. But the idea is the following: you will get to the point when you have your exposure of 100, even $100 million in several years, and usually in case when you actually have overcommitted. So your legal obligation should be higher. there's additional risks that in bad situations in the market, you will be obliged to provide more capital, and you will be overinvested. But in normal situation, you will be underinvested, and that's another thing to keep in mind. If you look at the global venture capital pooled net IRRs by vintage, here you will see the following picture. And it's as an industry, it shows not bad, right? It sounds interesting. 10 plus, sometimes close to 20 pooled IRR. But it means you have to be fully invested in all the strategies in the database, which is impossible, right? It's like all those indices of hedge funds and etc. It tells you something about the industry, but it is not investable. No ways to invest according to that. This is another source, remember, of information. It's Preqin Pro, similar picture, but numbers are slightly different. That's the global venture capital, and its median code up, distributed and residual value ratios by vintage years. It's more up to date than from PitchBook I showed you before, but here you can see that for vintages of before the dot-com bubble, that was the total money returned back was less than 1. And that's median. Of course, there are better funds, but median, it's a good characteristics. Look at that. It's not something huge, right, as an industry. So you are betting that you will get somebody from the manager's pool, some particular good manager, 1 or 2. That will provide you much better results than you see here. And remember, if you're a big limited partner investor, you will have maybe 10 managers in your portfolio. And then you have to look at median already here, or maybe even average numbers. Because even if you have 1 perfect manager, the other 9 might be close to median, or maybe below. That's to form correct expectations. This is median net multiples by vintage. Another information from Preqin. Still numbers are similar, right? Between 1 and 2, as well as here, between 1 and 2. So not that easy to get a lot of money in venture space. It's easy to make in particular investment in 1 or 2 companies. I mean, theoretically wise, there might be a case that you have many X on your investments. But if you look at this as a pooled vehicle, and not only the fund, but you have a lot of funds in your portfolio, it's becoming more and more difficult to get out of those median and average numbers. Okay, again, those numbers. Just I want you to know those numbers, understand those pictures. Interestingly enough, Preqin several years ago provided the data on that really, which goes back to 90s. And interesting enough, pre-dot-com financial crisis, the IRRs, first the dispersion was much better. I remember the industry was on the establishing at those times still, right? That was popular topic. But your multiples before the dot-com crisis actually were much higher, right? Because the distributed to paid in capital was actually the full multiple realized. You see to the right that it was close on average to 2x, right? But after the dot-com bubble, the multiples decreased. I assume that part of that effect is due to the database effect, right? And information on funds in those times. Part of that effect is due to the popularity of venture at those times and huge growth in valuations of new technology companies and ability to capitalize on that. But for you as an investor, that's something to keep in mind, that it's not that easy to get substantial return in venture capital. And it's also actually, it's more or less the same in other strategies as well. So not only the venture capital space is not that big, or I would say small, it's okay, $1 trillion globally, with 1/3 of that capital just being obligations or commitments, actually no dollar invested, they sit in somewhere in cash accounts of investors, not in the industry. But it's also very not that promising. But still, there is a role of the venture space in your portfolio as a big institutional investor, because the correlations of different sub-strategies are not one. So actually, the venture space follows the innovation cycles rather than other strategies, which are buyout strategies and capital markets. They more follow economic cycles. So as the innovation cycle and economic cycle differs, and they are not the same, actually venture capital can and does provide some low correlation into your portfolio. But I wanted to stress some other things, some important things on VC market now. If you look at the market, and this is the pitch book, if you look at the market, so the pool distributed to paid-in capital was decreasing, right? But the IRRs was increasing. So remember, it's all about that example with the fund having high IRR of 0 DPI. Always remember that it's important to understand whether your IRR is realized or unrealized. Always. In the end, that's your return. As traders say, if you haven't realized your return, or if you haven't cashed out, you have not realized your returns. You don't have returns. This is the J-curves, annual median net IRRs by vintage years of venture capital. And as you see, this is how it works in different vintage years differently, but it seems like you can see that maybe in 2, but more or less 3-4 years, sometimes up to 5 years, you have negative IRRs. Median fund, right? They are better, they are worse, but median numbers for US portfolio investor into venture space, it's important. So maybe your fund will show positive IRR, which will be mostly unrealized in 4 years. You should know that and remember. And now I have a question. How do you think, does venture capital outperform public equity markets? And how would you do that? Just maybe one minute. What do you think about that? Just think about that. Victor, is it possible that crisis influence the data? Of course possible, Victor. Number of funds in the data is different every year. Okay, now let's look at that. So when you're benchmarking against the public market, you first of all have to look at the same metrics. If you just simply compare IRR with returns in capital markets, it will be incorrect, because IRR is a money-weighted return, while in capital markets you see time-weighted returns, right? So first of all, you have to put them in the same direction. And it is being used by so-called public market equivalent or public market equivalent plus metric. What it does is actually just invest those cash flows being invested into the private capital fund or venture fund into the particular index, let's say Russell 2000. And then you have those multiples and you can calculate same IRR by the same direction. I'm sorry, same. First of all, you see that the number of funds in database is only dozens. Remember, every year you have hundreds of new funds being launched. So the databases are just a small part of the industry, even base databases. And here on the right, you see that the median IRR of the funds of median, right? And if you compare that with Russell 2000, it looks like the venture space was much better than public market. Right? It was much worse at the start of the century, but it was much better after the crisis. But does it actually outperforms? Remember, only good funds report. If you take the particular vintage year of out of 377 funds closed, we have in database on 23, so less than 10%. Most returns of this year, remember, unrealized, right? The DPI multiples are quite low. While in the public market, you can realize it next day. So it's a big question, actually, whether it outperforms or not. And in each case, it will be different answer to each investor. Again, look at that. And remember that some funds will be pitching you that with that thing. And another short question before we finish: do small VC funds better? Interestingly enough, using the same data, as far as I remember, Invesco, that was one of the big investment companies, they made analysis, and they found that actually, if you pull together IRRs of different VC funds by size, they found out that smaller funds outperform big funds. It's not always the case. Actually, different companies come to different conclusions. But if you look at this particular picture, you might say that, oh, yeah, I will be investing in only small funds, right? Not in big ones. But if you look at the McKinsey private markets review, they say differently, right? They say that larger funds outperform smaller funds over the past decade. And that might probably also the result of using different sets of data from different sets of from different sources. Even big names in the industry can come to different conclusions. So again, it's not public market. It's not freely available in Bloomberg or I don't know Zags.com or Yahoo Finance. Unfortunately, the industry is not that transparent. It's up to you to decide which funds are better. McKinsey says that bigger funds are better. Invesco says that smaller funds are better. Who knows? So feel free to share what you think about today's lecture. Appreciate any feedback. I have several questions in the chat. Seems like you don't like speaking at all, but okay. Can you describe the main problems of VC in Russia and what needs to be done to boost the industry? A lot of things have been done as far as you know, but it just doesn't. Interestingly enough, venture actually is working very well in English law and similar laws. So there are continental law and there is in English law, right? And continental law is not working very well. Continental law is not only Russia, it's actually even Germany. It's not that easy in Germany, but still the market is growing there. There are other reasons to that to come. But making venture investments in Germany still has some complications in comparison with UK and States. What's to be done? I'm not that particularly deeply involved in that, but there are many reasons. It's a complex project, and first of all, main problems is the small market. Russia is a big country, but it's small market, and consumers are not that, I would say, equipped with capital and money. The buying power is low, and it's becoming lower in the last 7 years, and it will become even lower. Is it possible to get the presentation slides? Victor, of course, as I promised, I will do that, but it's quite difficult to do it simultaneously. My question to all of you is to give me the list of all your names with your Gmail accounts. Then I will be able to set up in Google Classroom this class for all of you to get the materials and presentations as well. It was a very interesting comparison. Thanks. You are welcome. I'm trying. In Russia, there is also not well-developed exit infrastructure. I would not even talk about infrastructure, but just the exit. To make an exit here is, my question would be, how would you exit? IPO market is not working for small companies, mid-sized companies. It is from time to time you can do it, but look, mostly exits are being done by companies who are not just ventures, actually growth or private buyout, private equity buyout strategies, I would assume. You can just send them to our group mail. No, I don't like this idea. I just want to have the situation that you all in one place, and I can communicate with you. You can ask questions. I can give you tasks and etc. So you have to do that for sure. Yes, it was the idea. No IPO, not active M&A, etc. Yeah, a lot of things. But Maxim, just don't think only about that. Keep in mind that it's a complex thing. And as far as you see, it's difficult to make capital investments in the industry globally. And when you have the regional market specifics, it's even more difficult, right? So you actually have additional regional risk, which should be rewarded, but the sources of that reward are unknown yet. And again, the market is small. Chinese or Indian markets or European as a continental market, they are big enough. Of course, United States markets is much larger, and it's much larger both in terms of people living in the States and Canada, close to that, right? North America altogether. It is close to 400 million. In Europe, it's more than 500 million, right? In India and China, each more than 1 billion people. But here in Russia and CIS, it's okay. It's 100 plus, okay, altogether less than 200. With a lot of specifics and problems with logistics, many things to take into consideration. Okay, I hope that was a pleasure. Thanks a lot. Feel free to leave your feedback in the chat if it's more convenient to you. During the May holidays, as far as I see, you're not studying, but I will try to do my part of homework. I will prepare slides to send for you. I will prepare the Google Classroom. And maybe I will use this email to communicate with you as a group, just to do somehow information flow. Okay, I think there's no big problem. We will manage. Just give me a little bit time. Guys, any more questions? If not, I have to leave. But if yes, I'm happy to answer. You are very welcome. And sorry, video. I don't know. There is a problem. I think my Kaspersky has done something with that. I have to get that. Okay. Have a great weekend and May holidays. See you maybe in several weeks as far as I get already. And yes, next lecture, maybe next time it should be seminar. And I think we will be calculating and making those things on multiples, on fund investments, calculating IRRs, and etc. And comparing with public market benchmarks. Okay, see you soon. Bye-bye. Take care. It was a pleasure.